Well, good morning, everyone, and thank you so much for joining us today. All of us here at APRIUM hope you are safe and well, and we want to welcome you to the second of our four-part series titled Apriem Portfolio Construction. As Josh mentioned, I am Rhonda Ducote, President and Senior Wealth Manager, and I, along with Josh, one of our financial advisors here, will be your host today. We're going to be covering part 2 of the series, Laying the Foundation for Growth. Clearly, after this crazy year so far, investors have discovered the importance of holding bonds in their portfolio, especially as they enter retirement. Bonds can provide the foundation for a portfolio by providing stability and income. We'll review the various sectors in the bond market, from the speculative junk sectors to the high-quality government bond sector. As well, we will review APRIUM's approach to investing in bonds. I will now turn it back to Josh, and he's going to introduce our speakers today from our investment team.
Thank you so much, Rhonda. Now, I know a lot of you joined us already for part 1, but we do have some new folks that are joining us just starting here at part 2. So we're going to go ahead and reintroduce both Ben and Alan to you guys today. Benjamin Lau is the Chief Investment Officer here at APRIUM Advisors. He's a graduate of UC San Diego in 1998 with a bachelor's in economics. Later, he went on to become a Chartered Financial Analyst charter holder, otherwise known as a CFA. He has over 2 decades of experience, starting back in 1998 with Fidelity Investments, and later joining APRIUM in 2002. Ben's most recently been interviewed by the Wall Street Journal, giving his insight on the recent stock market meltdown amid COVID-19 fears, as well as discussing U.S. stock optimism and valuation on trade. Right alongside Ben is Alan Ahmatovic, a financial analyst for APRIUM Advisors. He's a graduate of CSU Fullerton in 2015, earning a BS in Business Administration with a concentration in finance. Alan is also a Chartered Financial Analyst charter holder. He got his start in the industry back in 2014 at Waddell & Reed as an intern, and later joined APRIUM in 2017. He's most recently been interviewed by Investor Business Daily on exploring investment opportunities amid COVID-19 pandemic. Ben, Alan, thank you for coming back for part 2 and taking us through this session on laying the foundation for growth.
Thanks, Josh. Appreciate that introduction. Before we get into fixed income, I wanted to do a quick recap of what we talked about last time, a couple of weeks ago. Last time we talked about asset allocation, right? What is that? The importance of diversification and really spreading out your assets amongst different baskets. Right? It's like spreading your eggs among different baskets. The baskets we really talked about are here on the screen here from left to right. Equities, really the growth of your portfolio. Fixed income or bonds, that's what we're going to be talking about today, and that's the safety part. Other asset classes are commodities like oil and gold, things that you use and eat. Another one is real estate. Think of your primary residence or investment property. And then, of course, the last bucket is the simplest one, cold, hard cash that everyone loves and stored under your mattress. But today we're really here to talk about bonds, right? And why it's important to help us really smooth out the ride and help provide a lot of diversification for portfolios. Now, bonds, a lot of people think bonds are boring. Right? And bonds, I find, could be boring because they're not as sexy as stocks, right? They don't jump up or go up and down like Tesla or Amazon. But bonds are really important. It's a huge part of the total capital markets, right? It's actually even one of the largest parts of the capital markets. It's massive, and it's really dominated by big institutions trading it. It's really a less speculative or less gambling part of the markets. And that's why institutions, pension funds, and endowments really dominate that space in the bond market. And because of that, it's really important, right? It provides us a lot of indicators on the economy and where we feel about the direction of the markets. And then it's really important for governments, right? Government lending and government borrowing is at the center, and interest rates are at the center of most economies. And Mr. James Carville back in '93 said this great, and that the bond market really can intimidate everyone here. So I'm going to go over a quick agenda here. Today, or the fixed income, we're going to talk about a few things. What is fixed income? Right? Some technical terms that we use for fixed income. How does APRIUM invest in fixed income? How do we get exposure there? And then why we do it that way? Why we think that we have a better niche in that fixed income market?
Thanks, Ben. Before we get into the nuts and bolts of fixed income and the bond market, we're going to start off with a quick trivia question. again, we're going to let you go ahead and plug in your answers in just a few seconds. So what is the total value of the global bond market? 10 trillion, 30 trillion, 100 trillion, or 300 trillion? Go ahead and plug in your answers, and we'll give you just a few minutes to do that. Okay, it looks like everybody has got their answers in. So Ben, why don't you give us the correct answer?
Before I give you the correct answer, let me tell you what the numbers are. So $10 trillion, that's the size of the gold market. Gold as an asset class is huge, $10 trillion. The U.S. equity market here is worth about $30 trillion in total, obviously dominated by all the big tech firms you guys know. And $100 trillion, that is the size of the global bond market. It is massive. We really, when you compare it to the U.S. stock market, which is only $30 trillion, the global bond market is at $100 trillion. Other fun fact, $300 trillion is the total amount of debt outstanding for the whole world, including non-traded debt.
So great. So why don't we get into it now? So Alan, can you tell us what are bonds?
Yeah, so kind of start from the basics here and then work our way up. So what are bonds? Bonds are loans, right? So they're a contractual agreement between an investor or a bond holder and an institution, otherwise known as an issuer, who's legally obligated to pay interest and return the principal amount of the bond at maturity, which marks the end of the contract. So this means that when an investor buys a bond, they are effectively loaning money to the institution that issued the bond. And so the typical bond is structured as a fixed rate loan, where the issuer pays a fixed dollar amount of interest on a semi-annual basis, and then returns the principal of the bond at maturity. And there's a few exceptions to this, which we do plan to touch on at a later point in the presentation. And it's also important to point out that when it comes to maturity, bonds can range from a few weeks to a few decades. And most large issuers actually have a range of different maturities. And they strategically plan these out based on the institution's leadership and kind of their plans.
So it's really good. I know that that bonds are considered to be conservative, but they do carry risk. You know, Alan, what would be the main risks that are associated with investing in bonds?
So investing in bonds comes with two primary risks, which we're going to dive deep into in the next few slides. The first one is interest rate risk, and the second is credit risk. And so the first that we're going to cover is interest rate risk. So this deals with how changes in the economy's interest rates impact the current price of our bonds. And the technical term for this is duration risk. And so like I stated earlier, the vast majority of all bonds are issued with a set maturity, which can range from a few weeks to a few decades, and are structured as fixed rate loans. So this means that when current interest rates change, it impacts the attractiveness of all bonds that are already on the market. And so the reason for this is that all new bonds that come to the market are going to be issued at the new prevailing interest rates. So this creates a strong cause and effect relationship between changes in interest rates and the current price of our bonds. And so you can really think of this relationship in terms of a teeter-totter. So when current interest rates, or yields as the technical term goes, when those go down, the bonds that are already on the market are going to offer higher interest payments than newly issued bonds. So they become more attractive and their prices go up. And the exact same relationship works from the other way around. When current interest rates or yields on bonds rise, the bonds that are already on the market are going to offer lower interest payments than newly issued bonds. So they actually become less attractive and their prices go down. And so it's also important to point out that the maturity of a bond really plays a critical factor here. And this is due to the fact that the longer dated a bond is, the more it stands to be positively or negatively impacted by changes in interest rates. And this is because these interest payments are locked in until the maturity of the bond.
So, Alan, do you think that you could give us kind of an example of what duration risk actually kind of looks like? Maybe a difference between a 1-year bond versus a 30-year bond.
Right. Yeah. So that's a perfect example to use. So take a 30-year bond and a 1-year bond. Say they're both issued today. Give the 1-year bond, say, a 1% interest rate, and the 30-year bond a 4% interest rate. If tomorrow interest rates across the board go up, the 30-year bond is going to be much more negatively impacted by that rate increase than the 1-year bond because it has already locked in a 4% interest rate for the next 30 years. The 1-year bond will get hurt, but not nearly as much since you're able to receive the principal amount back within the next 1 year and then reinvest at those higher interest rates. And so this is why duration risk is measured in years and is closely related to the maturity of a bond.
Great, Alan. This is really a tough concept to grasp for a lot of investors. Can you give us a concrete example of how changes in interest rates affect the price of bonds?
Yeah, so here's a really good chart that does a good job of showing the math behind this relationship. So this chart shows how a 1% spike in interest rates affects the current price of bonds with varying maturities and durations. So as you can see, there are 4 levels of duration shown across the top of the chart here. They range from 0 years on the left to 2 years, 4 years, and 6 years. And so as you can see, the math works out to where a 1% change up or down in interest rates will change the price of a bond based on the percentage amount that's equal to its duration. And so it's important to note that when we do discuss duration risk, we are referring to the current price of bonds. If we do hold our bonds through these ups and downs, we should receive the principal amount of the bond at maturity, assuming the issuer is still good for it.
Great, thank you for that example.
So this brings us to our second form of risk, which is credit risk. This one's a bit more simple to understand, and it really deals with 2 underlying factors. The first is the ability and the willingness of the issuer to make their interest payments in full and on time. And the second is the ability and willingness of the issuer to repay the principal amount of the bond at maturity. And so there are many factors at play here, which include the current financial condition and the outlook for the institution in question. So to simplify this, investors rely on 3 primary rating agencies. These are Moody's, Standard & Poor's, and Fitch, which are shown here at the top of the chart. And so what they do is they each perform an objective analysis of the issuer and determine a credit rating for their bonds. And this credit rating is extremely useful because it really gives investors the ability to universally compare the credit risk of all different types of bonds. And so from a high level, these ratings are categorized by investment grade, which are higher quality bonds, and non-investment grade, or high yield or junk bonds, or a few other terms for them, which are lower quality bonds. And so as you can see, the investment grade bonds, those are lower risk, so they offer lower return. And the high yield or junk bonds are a bit more high risk, so they offer a higher return. And so as you might be able to notice, the nomenclature is a little different for Moody's relative to the other 2 in terms of the credit ratings that they use. But the general idea is the same.
Okay, this is really great information, but can you tell us how this is used to make investment decisions?
Right, so the idea here is to earn a credit spread, which is the incremental return that's earned by taking on higher credit risk. So for example, one might look to invest in a bond issued by Lowe's, who's actually rated BBB+. When the economy is strong, construction spending is up, and consumer confidence is high. The reason for this is because there's a strong probability that they're going to be able to make these interest payments in full and on time, because those factors play a great deal into the success of their business. So keep in mind today that today's interest rates are very low compared to historical standards. But by doing this today, you could expect to earn about 1.6% per year on a 10-year Lowe's bond, and that compares to 0.6% on a lower risk 10-year U.S. government bond. So this comes out to a credit spread or carry or incremental return of about 1%.
Great, thank you.
So now this brings us to the different bond sectors. So from a very high level, there's 3 different sectors of bonds. And it's important to point out that when it comes to risk and return, the primary difference between these 3 is credit risk. All are going to carry a certain level of interest rate risk, just based on the maturity of the specific bond in question. So the first sector we're going to cover are government bonds. So these are bonds that are issued or guaranteed by the U.S. federal government. The first category here are U.S. Treasury bonds, which are bonds issued directly by the federal government, who in turn use the funds as well as tax receipts just to fund the wide array of different federal programs within the United States. And U.S. Treasury bonds are considered risk-free. So whenever you hear the term risk-free rate, it's actually referring to the interest rate on U.S. Treasury bonds. And the second type of government bond are government agency bonds. And these are bonds that are issued by government agencies and are guaranteed by the full faith and credit of the U.S. government. And the prime example here are mortgage-backed securities, which are issued by government agencies like Fannie Mae and Freddie Mac. And these bonds are based on the interest and principal payments of high-quality mortgages within the United States. They're not technically risk-free, but they're close to it, since they are guaranteed by the U.S. government. So to compensate for the slightly higher credit risk, they offer a marginally higher interest rate. And so also it's important to point out that in general, there are also other types of mortgage-backed securities and asset-backed securities for that matter, which are considered riskier and not backed by the U.S. government, but these fall into a separate subcategory. The second sector we're going to go over are municipal bonds. And these are bonds that are issued by state and local governments, which in turn use the funds to invest in various projects like infrastructure, education, and environmental programs. And these are broken down into two categories, which really deal with the structure of the project and how investors get paid back. The first are general obligation bonds, or GO bonds. And these bonds are paid back through the general budget of a given municipality. And the second are revenue bonds, which are paid back through the revenues that are generated by a specific project. So they're generally considered a bit more risky than the general obligation bonds, since they're dependent on the success of a specific project. And so overall, there's no real rule of thumb for the credit rating of municipal bonds. They can range from very low risk, like an Orange County education bond, to very high risk, like a Puerto Rico bond. And lastly, the last sector here that we're going to go over are corporate bonds. So these are bonds that are issued by corporations, which in turn use the proceeds to fund their operations and grow their business. And these are broken down into two categories. The first are fixed rate bonds, and these include investment grade corporate bonds, which are bonds that are issued by financially healthy corporations, and high yield or junk bonds, which are bonds that are issued by not so financially healthy corporations. And so a few examples here, two examples of a high quality investment grade corporate bond would be bonds issued by Johnson & Johnson and Microsoft. And a few examples of some lower quality junk bonds would be bonds issued by Ford and American Airlines. And the second category here under corporate bonds are floating rate bonds. And these are bonds that are typically only issued by smaller or financially weaker companies who either have too much fixed rate debt outstanding or are just not able to issue fixed rate bonds. And the interest payments on these bonds, they adjust, they go up and down depending on the changes in interest rates in the broad economy. So the real positive for these is they come with virtually no interest rate risk or duration risk because their payments adjust. But the catch is these bonds come with substantially higher credit risk as they're only utilized by smaller or financially weak corporations.
Thank you, Alan. You know, as we look at the screen and we look at this varying amount of different types of bonds that are available, and they're all over kind of the risk-reward spectrum, I have to say one of the questions I get very, very frequently as an advisor coming from retirees who are receiving income in retirement, oftentimes I'm being asked, why is it that in our taxable accounts, so our non-retirement accounts, why aren't we holding more municipal bonds? You know, if it's going to generate tax-free income for me, I'm in retirement, I'm taking that income, wouldn't it be better that I hold these municipal bonds over corporate bonds or bond funds?
Yeah, it is a really great question. But it is important to point out that while municipal bonds can be a really good tool because they are tax-free, it's also important to compare the interest rate that you're getting on a municipal bond to that of a corporate or government bond, because they may offer a lower tax equivalent yield when you adjust for the fact that they're tax-free. So an example could be you could take a tax-free municipal bond that's earning 1% and a corporate bond that's earning about 4%. So even though the corporate bond is taxed, you still might end up getting an after-tax higher return. So it's important to do that comparison before just jumping into only owning municipal bonds. And the other important thing to point out too is municipal bonds are their own sector of the bond market. So you do also want to kind of diversify your bond holdings and not just be 100% in one sector. So while they are used as a good tool, it's important to point out that it's not just a catch-all, the 100% right thing to do in every scenario.
Thank you, Alan. I think that now is a good time to get into our next trivia question. So as we get in there, I will launch the poll for everyone. Okay, so here's the question. Who is the largest non-bank corporate debtor in the United States? Is it ExxonMobil, Macy's, AT&T, or General Electric? We'll go ahead and get started and give you guys just about a minute to submit your answers. We actually have 28% says ExxonMobil and 72% of respondents say General Electric. Alan, what is the correct answer?
So the correct answer actually is C, AT&T. And kind of a fun fact here, AT&T has about $180 billion in debt outstanding. And that's actually more than the countries of New Zealand, Croatia, and Costa Rica combined.
Wow, that's really interesting, Alan. Thanks for going over the risk and some of these terminology on bonds. So I'm going to cover how does APRIUM invest in bonds here. And so on the next few slides. So before I get into that, I want to cover a couple of things. Talk about ways we invest. There are two real strategies that we use when investing in bonds, right? And on the left side, we can go just like with equities, we can go with something that's passively managed, right? Just follow an index for it, or something that's actively managed, where they're trying to beat the index. Well, first of all, let's define the index. The index is, for all intents and purposes here in America, something called the Bloomberg U.S. Aggregate Index. Some of you that have been around a little longer would remember as the Lehman U.S. Aggregate Index, and then the Barclays U.S. Aggregate Index. Now it's the Bloomberg U.S. Aggregate Index. They bought them. The U.S. government treasuries make up about 38% of the index. The second one is mortgages, which are guaranteed by the government. So they're government agency bonds, and that makes up about another 29% of the index. So you're looking at almost 70% of the index is really government or government agency bonds. So it's really high quality. Because it's a government bonds, it's also what we have, what Alan was mentioning, it's a little bit longer in duration. So you have a little bit more of an interest rate risk if things go up and down. And then to top it all off, the benchmark yield's about 1.3%. So you're not getting really paid a lot to own bonds right now in terms of the yield. They really provide more of a safety mechanism when you go in something like the aggregate index. If you want to go, if you don't want to just buy the index, you can also buy some actively managed fixed income products. And so actively managed funds really just focus on something, right? They focus on something like the municipal bond market that you guys were talking about a second ago, or credit bonds, or high yield bonds. So you also hire a specialist to get really targeted areas of that. And then so how we also do it is investment vehicles. Once you kind of decide what you want to do, how are you going to do it? And there's really three ways to invest in bonds now as we look at in 2020, right? Back maybe 10, 15, 20 years ago, 25 years ago, most, I think, investors would get their bond exposure through buying individual bonds. Calling a Fidelity or Charles Schwab, calling up the inventory desk and saying, hey, what kind of bonds do you guys have on your inventories, and picking the best one that you would like. They would give you that fixed rate that Alan was talking about. It'd be a fixed interest payment. It'd be a fixed maturity. And so you buy the bond and build a portfolio like that. But since about 2000, ever since the technology wreck and a bunch of legislation that came out of that, banks just don't hold that much bonds on their inventory anymore due to the capital requirements. So buying bonds has been a lot tougher in the last 20 years or so. But it's just harder to trade. The selection that the bond desk have is a lot weaker than ever before. So that's been really difficult. So with that, we started using more ETFs and mutual funds to get that exposure. And for ETFs like stocks are exchange traded funds that usually follow a passive index like the U.S. Ag here, and they trade intraday. We also use mutual funds here at APRIUM. Mutual funds are generally a little more actively managed, and they target a specific area of the bond market. Frankly, everyone, we were a little indifferent to ETFs and mutual funds in the bond space for most of the past few years, up until about this year when we noticed some irregularities with ETF bond trading. And we noticed that some of the bond ETFs were kind of getting moved around in price during the whole COVID crisis, where the prices of the ETFs weren't really reflective of the individual bonds that they were holding. And so that was a kind of a shocking turn for us. We didn't realize that would happen, and I don't think the bond market structure wasn't ready for the ETF market. And I think we're really leading more towards mutual funds in this space over ETFs at this point. So how APRIUM decides to invest in is that we do both, right? We don't have a one size fits all. We do both. We invest in active and passive strategies, and we use ETFs and mutual funds. So we use what we call a core and satellite approach. The core of our fixed income is the one in the middle, this Charles Schwab index fund called the U.S. Aggregate Index. That the symbol you see on your statements is SCHZ or SWAGX are the two main symbols that we use for that. And that's the core. That's the high quality part of the portfolio. This is the benchmark. Okay? This has a lot of treasuries, and this has done really well this year. The core has done really well given all the crises we've seen around the world. On the satellite areas, we have a couple of companies that we use. The first one is River North Funds, a great company based out of Chicago. They do really closed-end funds and a specialist there, a great fund there. Lord Abbett is a U.S.-based company. They really focus on short-term bonds and what we call credit bonds, right? They invest in short-term bonds. You're not going to get much of a yield on short-term stuff, so they go for more speculative grade companies, and they're really specialists in that area. Numbers 3 and 4, I think I'm sorry, in Lord Abbett, we don't own that. We actually sold that position about a year ago now, and so we actually do a lot of rotation in this satellite area. The third one is DoubleLine. We use a DoubleLine total return fund, which you should see in your statements. DoubleLine is managed out of LA. They're about a great specialist in the mortgage market. That's really the bread and butter is the mortgage market, and so they're a great manager there, and really high quality. And then the last one is PIMCO. I think most of you will recognize PIMCO, right? One of the largest employers here in Orange County, based near the beach in Newport Beach, in that massive building. And they're one of the largest, if not the largest bond manager in the world right now. And their real focus, their real bread and butter is what we call credit, like Alan was mentioning. Not really treasury bonds, but these bonds of corporations, investment grade bonds, high yield bonds. That's really their focus.
So before we move forward, I'd love to kind of tie the previous slide and this slide together. And correct me if I'm wrong, Ben, but as I look at this, that core piece of the core satellite approach here, when we're looking at Charles Schwab, that is a passively managed strategy, correct? Mm-hmm. And then the satellite pieces that are around it are the actively managed pieces. And so essentially with that core piece, and you kind of mentioned it before when we were talking about the passive strategy, it's going to have provide a bit more safety, mm-hmm. maybe a little bit lower yield, right? Whereas the actively managed pieces in the satellite spots there might be a little bit more risk, but provide a bit more yield. Am I thinking of that properly?
Yeah, that's a great way to put it, Josh. That's a great way because the core is our passive approach, and the satellites are almost all active managers, which we rotate and monitor.
Thank you.
Mm-hmm.
Yeah, that's great. I think, this is huge for our client portfolios, is to understand how APRIUM invests in the fixed income and bond market. So thank you for explaining that. I think that most of our clients will really appreciate that. It's very confusing. So anyway, that takes us to our third and final trivia question of the day. So again, we've just launched the polling. And so basically, we're going to say, what is the average transaction cost for retail investors to buy or sell a corporate or muni bond? Is it A, $5 per trade, B, $10 per trade, 2%, or 5%?
So we had a tie between $5 per trade or 2%. Benjamin?
The answer is, I'm surprised most people got this, is 2%. 2% is the average transaction cost when investors buy or sell a corporate bond or muni bond. That's kind of high, don't you think? I mean, especially when you consider I have a friend that's selling their home right now. They're paying 3% to sell their home to a broker that has to make sure the house looks nice, get pictures taken, market the property, do open houses, all for 3%. And 2% for a bond is kind of high. And in fact, that cost is still consistent. It's been consistent for about 15 years now, where it's just harder to transact bonds. And you don't even, the worst thing about this is that you don't even see that 2%. It's called a markup. And the only way you can really grab this information is really two ways. For municipal bonds, you can go to EMMA, a website that is managed by the MSRB, and get the last trade for that bond you're trying to buy. For corporates, you really have to buy a Bloomberg terminal, which costs about $2,000 a month, right? And that's the way you can only get the real prices for how these bonds are trading in the background. Because that price that you see at Schwab, it includes all the fees and markups along the way. And so 2% is a pretty high rate, I think.
Yeah, I think that's really interesting because I think a lot of investors, when they invest in bonds, they don't realize that is embedded in the cost of it. So it's a very high markup for purchasing bonds. So thank you for explaining that.
And so that really leads us into why APRIUM invests in this. Why do we use passive, as Josh was asking, in the core space? Why are we using funds like PIMCO and Double Line? And that's the trivia question is really that was the big one. For most clients, buying a bond, a 10-piece bond or a 25,000-piece bond, is extraordinarily expensive. It's going to cost you 1% to 2%, about 2% to trade the bond. That's kind of high, relative to cost and relative to a market that's yielding about 2% in general. And so the interests are so low, you got to save money on cost. And so that's why we do that. And it's also harder to buy bonds. So that's why we use index funds to get that core exposure. It's cheap. It has a very low expense ratio and it's very efficient. And then to add layers on that, we really want to partner with a specialist for better returns, right? We know that we're not going to get the returns for you all by just investing in treasuries and agencies, right? We want to go in other eclectic areas of the bond market that can offer extra return. And we want a specialist to do that, whether it's Double Line that just does mortgages or PIMCO that really focuses on credit. In the past, we've owned other types of bonds like high yield and rotated out of those. And also, especially given now where interest rates are so low, we want to manage to also adjust duration depending on the interest rate environments, right? Maybe short duration when interest rates are low or lengthen duration when interest rates are high. And so we want to be able to move on that. And of course, we want to get paid for taking on that additional credit risk or carry that we all mentioned. But the interesting thing is that, or the most important thing for us is really the fees that we pay, right? It's not just an all or nothing thing for us. We want to make sure that we are these managers do come with extra fees, and we're investing in managers that have low fees and generating substantial returns for our clients.
The first question I have is, why does the value of bonds decline when interest rates rise?
So I could take that one. So the reason the value of bonds decline when interest rates rise is because with the bond market, there's governments and corporations that are constantly issuing new bonds on the market to fund their operations and their growth. And so when they issue a new bond, that bond's going to be issued at a higher interest rate compared to some older bonds now that interest rates have gone up. So that makes those older bonds that are on the market that we're currently holding in our portfolio, it makes them less attractive because they offer a lower interest payment compared to the new ones. So that's the whole idea behind that teeter-totter and interest rate risk. When interest rates and bond prices really do move it in kind of an inverse direction.
Yeah, an example that I've always given has been, imagine that you purchase something like a 5-year bond, right? Your coupon or interest rate essentially stays fixed the whole time. So even though you hear on the news that, hey, interest rates are rising, it doesn't mean that bond that you purchased, interest rate is rising. It's going to stay where it's at. And let's say it's been 2 years, you have 3 years left on that bond, but you need the cash. You need it for whatever it is. We got to pay something down and we need to get our cash out of there. Well, you can sell that bond. And when you go to do it, if I was going to sell my bond that's now a 3-year bond at, let's say, 2%, and I'm going to sell it to Alan, but Alan could go out and buy a brand new 3-year bond and get 2.5%. He's not going to pay me full price. He's not going to pay me what I paid for it, right? So I have to sell it to him at a discount. And there's some math that goes into it to essentially net it out at a break even where it's of value to both of us. But that's the way I like to think of it. That's why it makes so much sense when you really start to break it down to those levels. Hey, interest rates have gone up. The value of my bond is no longer as valuable as it was when I got it because you can get a new one out there that has a better rate. So hopefully that's helpful. Rhonda, would you like to take the next question?
Sure. I thought this was a really good one. Do companies still issue bearer bonds?
Bearer bonds, no, not really. Bearer bonds, I don't know if some of you remember, bearer bonds, the title is really how it's traded, right? The bearer of the bond, the person holding the bond can bring it to a bank and redeem them for cash. With technology, bearer bonds have really gone away, and most bonds are now traded electronically, and just makes it easier. You don't have to go to the bank every couple months and then give them the coupon and you get your interest or give them the principal back. So electronic trading has really made it much more easy. The second thing is obviously what we call AML here, or anti-money laundering. Bearer bonds are highly used for illicit purposes, so that's why most Secret Service agencies have gotten rid of that.
Well, they're probably a collector's item.
Yeah.
Open up the safe. I remember back in the early days, in the early 90s, where people would bring them in and, you'd clip the coupons and you take it in and, get your interest payment that way. So it's definitely, technology has made it a lot easier to collect your interest payments. But a great question.
Yeah.
Definitely.
If we feel good, I've got another question for us here.
Go for it.
I think this one's kind of fun. So, are banks expecting more loan defaults ahead due to the pandemic?
Oh yes. I mean, oh yeah. And I mean we're joking about it, but it is true, and it's been a big topic this week. Because banks, especially the major banks, are starting to report. And we're what it's called earnings season right now, where companies are reporting second quarter earnings, and obviously with COVID, it's been rough. And banks usually kick off earnings season. The first one this week was JP Morgan, followed by Citi, Wells, and Bank of America, and Goldman this week. And by and large, yes, almost every bank out there is setting aside what they call loan loss reserves, expecting, based on their models, how much the defaults, who's going to miss payments, and how should we allocate for that. And so right now, for example, JP Morgan has set aside approximately $30 billion in loan loss reserves between the last maybe 60 days. They've only experienced about a little less than $2 billion in losses and defaults. And so, but they're setting aside another 28 for potential future ones. And yeah, they're expecting a default to increase substantially. For something like JP Morgan, they're expected to see losses on the consumer side and on the corporate side too. So it's going to be across the board. And they're predicting this to be pretty long, what we call credit cycle, probably starting about now, lasting for about a year.
Right. Okay, here's another one. How often do companies call their bonds and issue new ones when interest rates drop? Great question.
That's a great question.
Yeah. It's really going to be dependent on the structure of the bond. So some bonds are considered callable, some aren't. But yeah, it is going to occur a lot more often when interest rates are coming down, because really it kind of works the same way as like refinancing a home. It's like if interest rates drop, a company is going to be able to issue a bond at a lower rate, pay off the old one, and then be able to have that new bond at a lower rate to pay off going forward. I think generally over the past few years, right, we've seen a good amount as interest rates have come down a lot. We're near 0% today. So it has happened a pretty good amount.
Yeah, well, first of all, I mean, when the company issues the bond, they have to write that in what they call covenants. So a good investment banker would write that in there. Not all do, in different terms. If you write it in, if you want that feature as an issuer, as say AT&T or somebody does that, you're going to pay for that feature. So you got to pay a higher yield. So AT&T has to ask themselves, do we want to pay a higher yield to have that call feature for potential down the road? The other thing, and I think that the refinancing of the house is a great analogy, because if interest rates fall, that probably means that there's something going on with the economy, right? There's some disturbance, whether it's coronavirus or COVID or the great financial crisis 12 years ago now. And so not even if a company can call their bond, they have the legal ability to, not all companies can, right? So look at right now, look what's going on right now. The best companies are able to refinance at lower rates. So they call their bonds like Amazon and Apple and Lowe's, like Alan was mentioning. But think about some of the issuers that cannot call their bonds right now because they don't have the cash flow to refinance. And think about all the oil companies, right? Oil companies would love to refinance at lower rates, so they just can't. They don't have the cash flow to do it right now.
Good point.
Wow. So here's another question. Do most of our bonds, bond portfolios, seek to maintain an average fixed term of, say, 7 years or 13 years or whatever?
No. No, because we do manage it, right? We know that we're not just sitting in these 4 funds that we mentioned a while ago. We've been rotating our bond exposure quite a bit. And so, as I said a couple of years ago, we had shortened the duration by investing in floating rate bonds and other investments and add less money in that core position. So our duration was a lot shorter about a couple of years ago. And starting about a year ago, we actually lengthened our duration just because we thought we were just getting paid for that risk. And that actually worked out really well for us this year. And so we've been adjusting that. So we don't do a constant term. In fact, Josh, right now, our average duration on the portfolio is about 4.5. Mm-hmm. So well under the benchmark.
Yeah, much lower than the benchmarks. The benchmarks is closer to 6 or 7.
Great. I think we have time for a couple more. Josh, you want to take another one?
Sure. Actually, I would like to do a follow-up question to add on to the question that was asking about the expectation for more defaults ahead due to pandemic.
Okay.
So if I was in an investor's shoes, I would want to know if you guys are already seeing that and expecting that. We know that's what's coming. What are we doing to manage that potential risk moving forward?
Well, that's a great question.
It comes down to shoring up the quality of our fixed income portfolio. So what we've done, even coming up to that, up until now, we already were moving in that direction because we saw that we were in kind of the later stages of the economic cycle. But with everything happening with COVID, it really making that move early really did pay off for us. We continue to look to just improve the overall quality, increase the allocation to government securities, high quality mortgage-backed securities, high quality corporate securities, because if the economy does continue to suffer and things get worse, those are the places that you want to be in the bond market, because that's where your principal is safest and your cash flow is most predictable. So we're definitely taking steps in that direction.
Mm-hmm. At some point, though, I do want to say that as when the default rates do start happening, and that spread that I was mentioning a while ago it jumps up, meaning that we're getting compensated to take on additional risk. I think we will look at maybe adding credit exposure in the future, but not right now. We're very credit light, and so we've been really fortunate to be in that space.
Great. I think this is kind of a follow-up to that same thought process. You guys had mentioned that the bond market is so much larger than the equity market as a whole. How does APRIUM do? There's so many funds out there, and so many, whether it's individual issues or bond funds or bond ETFs, as we've talked about in the presentation. How does APRIUM decide which fund is better than the other, and what type of research do you do in that type of scenario?
Yeah, well, we talked about this a little bit on the previous slide, Rhonda, and we talked about how we don't buy a lot of individual bonds anymore. We really stick with bond ETFs and mutual funds, and frankly, more towards bond mutual funds at this point, given our concerns about the fixed income ETF market here. The first one, and I'm going to address this using the core satellite approach that we've been talking about. On the core, that's index fund, the benchmark, right? It's cheap. Let's get that exposure as cheap as possible, as efficient as possible. Schwab has a great product, but we're in the middle of a price war for a lot of these products, and so there's a lot of other competing products out there that are just as cheap or just as good. And so we try to keep that exposure cheap and get what we call try to get a fund that represents our benchmark very well. And so that's been pretty easy to do with Schwab or a host of Vanguard or iShares products out there. And the second one is that settling. That's a little bit harder. I think that's really where your question arises. It's a lot. We use a lot of different resources. We use obviously a Morningstar. I think Morningstar is a really popular and really great resource for a lot of investors to use out there. It gives you a nice analysis on bond investing, but not the best, right? And we use a lot of internal dialogue with the actual fund management companies. We interview PIMCO and DoubleLine and River North, those guys. A few times a year, we get a look into the portfolios and where they're going and mistakes and wins that they've had. But we also use Bloomberg to do that analysis too, because we just don't rely on their data. And so we really use Bloomberg a lot to really dig in and dig into their portfolios. How we get that is that we do use screeners, but we also look at cost too. Cost and performance is a big factor.
Great. Well, thank you for explaining that. I think that's about all the time we have for questions. We have about 5 more minutes left. And Josh was going to talk a little bit about some upcoming events before we close out.
Do you think we could really quickly address one last question? I thought it was good. Okay, there's one last question on here, and it's, how's the staff holding out during these turbulent times? Is working at home placing too much stress on the team? So, guys, how do you feel about the time spent working at home, and how's the rest of the staff doing? I think everyone should hear and know kind of what we're doing as a whole, just due to coronavirus.
I love it. Well, whoever asked that, thank you so much for asking that. That was very nice.
To be honest, it's nice to not have to sit next to Ben every day.
I'll be honest. You guys can have a different answer. I'll answer it for myself. I don't really like it, to be honest. It's been convenient in some ways, and we've been really fortunate that our technology stack has really allowed us to do that. We're mostly cloud-based, about 90% cloud-based. We have laptops and everything, so we can do this job remotely. So we're able to service you remotely. But personally, especially when I lead the investment team, I think that people in close proximity, that's how ideas are made, and that's how creativity happens. And that's the best thing when Alan and I are sitting together, although he doesn't like it. When Alan and I are sitting together, when Matt's there, when Jen's there, when Rhonda's there, and Harmon's there, when Josh is there, and Chris and Landon are there, we're all talking about it, collaborating. That's how ideas get made and great ideas happen. And so I am working from home right now, but I do like coming to the office.
Yeah, I totally agree with that. It's the collaboration and the teamwork and the ideas that come about when we are working together it's super huge, and it's really difficult to replicate when everybody's separated. So I mean, there's parts of it that are might be a little bit more efficient and stuff, but yeah, when it comes to that creativity behind it, it's really hard to get when we're not all together.
Well, that makes me feel really good that everybody likes to come to work. But I will say, from a leadership standpoint, it's been trying. I think most of us here are people persons, if you will, and so we miss the interaction with all of our clients and potential clients. So talking through a computer has its pluses and its minuses, but we all are looking forward, I think, and I can say this for all of us, getting back to, whatever used to be normal.
Yeah.
Okay. I know some things will change, and we don't know how long we're going to be doing business like this. And I think a lot of people that I talk to on a daily basis and businesses I talk to, they're looking forward to it too. But it may be like this for the foreseeable future, maybe the rest of this year, we're not sure. But again, thank you all so much for asking. That was a great question, and we appreciate your concern as well. So, what about you, Josh?
I'm kind of on the same page there. I miss meeting with people face to face. I think that was one of the things I enjoyed most. I don't. While you guys can all see us right now, we can't see any of you. And I miss meeting with people face to face. I think that's one of the fun things about our job is we get to continually see everyone and help more people and sit with everyone, and and you build that relationship, and the relationships are long term. They last for many, many years, and I miss that side of things. I do, of course, miss spending time with the team. At home, I mean, you get a lot of work done. It's easy to make a lot of phone calls and talk to a lot of people and do a lot of emails. You get all that, you get caught up on all that busy work that piled up, because you weren't at your desk, you were in meetings and all. So you can get a lot of work done from home just fine, and being virtual, I think, is huge. We do meet as a team every morning at 9 a.m. We all get together on a call like this, and everyone's cameras are on, and we all, so we're continuing to stay in close contact with each other. But, it's just missing that element of camaraderie that you get when everyone's in the office.
Absolutely. Great question. Well, Josh, why don't you take us into some future events, the last two of our Portfolio Construction Series.
All right. So congratulations, you've made it halfway through. So it's time for midterms. Does everybody study up, and are you guys ready for a midterm test right now? No. Okay, so this was part 2. It's a 4-part series. I think that part 3, which is coming up, is what everyone's really most excited for, right? We're talking about growing our wealth. So we got through asset allocation, which is that kind of blueprint. We've talked about laying the foundation. That was all today, putting in that conservative piece of the portfolio that we need and is important. But now we get to talk about equities. We get to talk about how do you select individual stocks that you want to purchase. And so on July 29th, that will be part 3. That's going to be the key topic of conversation that we're going to go through is really, Ben, Alan, your team, what's your guys' approach for picking individual equities? How do you build up that equity piece of the portfolio? And then on August 12th, that'll bring everything together. It's part 4. It's really talking about what do we do after the portfolio is set up, and why is what's happening after everything's been put in place so important? What does that do for you from a long-term perspective? So looking forward to seeing everybody there. Invite your friends. We would love to have some new folks join us. And then that being said, if we could flip forward to the next slide here, Alan. Our previous webinars are available on our website. So if you go to aprium.com, you can scroll down to the bottom of the page. There's a running feed of recent events. And you can watch the past recordings. So earlier this year, we did a Financial Planning 101 event for the Women of Wisdom program that Rhonda leads. But if you're a guy, you can get in there and you can still watch it. It's a really nice pink presentation talking about the results of 1,000.
My favorite color, Joshua.
It looks good on you. So that's on the results of 1,000 potential futures, which is really talking about Monte Carlo simulations and how that helps through decision making in your financial plan. And it also gets into kind of all the key different pieces of financial planning along the way. And then if anybody has missed part 1, you had to leave halfway through, you just want to review what we talked about, or you want to send it to someone else, part 1, which was on asset allocation, that was the building blocks of portfolio management, that's also available on the website. When this is all said and done, we'll get this recorded presentation tailored and put on the website as well. And then if you want to register for the upcoming events, that's available on the website as well. There's a banner at the top of the page. You can click there. Tomorrow we will have the new registration links available on the website to register for part 3, and you'll get an email as a reminder. I think that's what I've got as far as what my shameless plug there.
Well, and another comment just came in too that someone had just said that they really enjoy the weekly updates, the weekly emails that we've been sending out on Thursdays and Fridays. So those will keep coming. So, if you ever want those resent to you, give us a call or shoot us an email. Also, schedule your portfolio review. It's the end of the quarter, June 30th, Q2. So if you haven't done so, please reach out. We can set up a Zoom or GoToMeeting meeting, as well as, or if you have questions after this event, feel free to give us a call. With that, I want to thank you all so much for attending today and participating. Thank you for all the great questions. We hope you found it helpful, interesting, educational. We, of course, would love your feedback, as always. Immediately following the event today, you're going to get an email. We made it a little bit easier than the last time, so if you get that, and if you can take just a few minutes to give us your feedback on the content, and if you found it helpful, that would be really great. But with that, that concludes our event today. Thank you so much for participating. Have a wonderful day. Stay safe. Stay well. As always, we're here if you need us. So thank you so much, and take care. Bye-bye, everybody.
Bye, everyone.
Bye. Thank you.